TSMC's Arizona plant matches Taiwan chip yields. Moving from open source to proprietary license is not always a means to financial growth. And Salesforce shakes up AI pricing with a new per-conversation model. All this and more on the Price is Right edition of #Trending. I'm your host, Jim Love. Let's get into it. In a significant development for the U.S. semiconductor industry, Taiwan Semiconductor Manufacturing Corporation, TSMC, has reportedly achieved production yields at its new Arizona facility that match those of its established plants in Taiwan. This milestone comes from a recent trial production run using advanced 4-nanometer process technology, according to an anonymous source familiar with the company's operations. The $65 billion Arizona project, consisting of 3 fab plants, represents the largest foreign direct investment in both Arizona's history and in a U.S. greenfield project. It's a crucial part of the U.S. government's efforts to bolster domestic chip manufacturing, with TSMC set to receive up to $6.6 billion in grants and $5 billion in loans for the initiative. Despite initial delays due to workforce challenges and cultural differences, TSMC's success in matching Taiwanese yield rates is a positive sign for the project's viability. It's also contrasted with Intel's difficulties in achieving production quality with its fabrication plants in the United States. The first fab plant for TSMC is now scheduled to begin mass production in the first half of 2025, with the second and third fabs focusing on even more advanced 2-nanometer and 3-nanometer processes in the following years. This development is particularly noteworthy as it addresses previous concerns about whether TSMC could maintain its high-efficiency standards outside of Taiwan. With comparable yields, the company should be able to maintain its targeted gross margin rates of 53% or higher in its U.S. operations. Compare this with the struggles that Intel has had with both its profitability and maintaining quality in its North American plants. As the global chip shortage continues to impact various industries, TSMC's progress in Arizona represents a significant step towards enhancing the resilience of the U.S. semiconductor supply chain. It also demonstrates the potential for successful high-tech manufacturing collaborations between U.S. and Asian allies. In light of Elastic's recent move from an open source to a proprietary license, there is a small but real trend of companies switching their software from open source to proprietary licenses. But does this strategy actually improve their bottom line? The results say it's not that clear-cut. Rachel Stevens of RedMonk examined the financial outcomes of 4 major tech companies: MongoDB, Elastic, HashiCorp, and Confluent, all of which made the transition from open source to proprietary licensing models. The study focused on changes in revenue, market capitalization, and net income before and after the license changes. The results paint what can only be called a nuanced picture. While all 4 companies saw revenue growth after changing licenses, the rate of increase wasn't significantly different from their pre-change trajectory. This suggests that license changes alone may not be the revenue booster that some companies might expect. Market capitalization told a more varied story. MongoDB experienced substantial growth post-license change, Elastic saw moderate gains, but HashiCorp actually lost value. These mixed results indicate that changing to a proprietary license doesn't guarantee an increase in company valuation. Interestingly, none of the companies studied have yet achieved profitability, with their valuations primarily driven by expected future growth. This underscores the complex factors at play in tech company valuations beyond just licensing models. But there are other issues that might affect the end users of the software and the open source community in general. There's always been a suspicion about converting an open source company to a proprietary model. Decades ago, companies like Sugar CRM, who had leveraged a community of developers for their initial development and market penetration, moved to a proprietary model, and some felt abandoned the people who had built the software and essentially allowed corporate and other investors to be able to profit from their innovation and labor. Recently, IBM's acquisition of Red Hat ultimately led to some friction with the rest of the open source Linux community. But these recent changes may stem from another rationale. Elastic's recent shift to proprietary licensing was at least in part because public cloud providers were offering their open source version as a service. So these open source companies were providing free software to giant tech companies who may or may not have contributed anything to their development. Stevens' report doesn't really look at this impact on the open source world, but it is taking some first steps in perhaps initiating a larger discussion about the future of open source. This conversion to proprietary software is only one aspect, but it is, according to this report, a strategy that's gaining traction, especially in the database sector. And the report indicates that the debate over open source versus proprietary licensing continues, and this study suggests that companies need to carefully consider their motivations for their licensing changes. While it may seem like a straightforward path to improved financials, the reality appears far more complex. And in a move that could reshape the AI industry's pricing landscape, Salesforce has announced a cost structure for its upcoming AI agent. CEO Mark Benioff revealed that the company plans to charge $2 per conversation for their AI tool, potentially setting a new standard in the rapidly evolving market for enterprise AI solutions. This pricing strategy comes as Benioff takes aim at competitor Microsoft, claiming their generative AI product Copilot has left many customers underwhelmed. By offering a pay-per-use model at what the company feels is a competitive rate, Salesforce is positioning itself to capture a significant share of the growing demand for AI-powered business tools. This $2 per conversation pricing can have far-reaching implications for an industry that is struggling to move from free to paid to recover some of their investments. It may pressure other major players to reconsider their pricing models. For businesses, this could mean more flexibility in integrating AI into their operations without committing to fixed subscription fees. However, questions remain about this model. At $2 per call, it's likely to be a cost saving if compared with a skilled agent, provided it can provide an equal level of service and replace at least some operators. That would be a very sophisticated system. If it turns out to be the equivalent of what could be handled by a simple AI agent or simply augmenting the agents, it could end up being a costly alternative. If it ends up not replacing but simply augmenting agents, the level of productivity it delivered would be one of the factors to consider in whether it was something new, an additional cost, or a cost saving. And there is a real danger, as we've noted before, in the death of 1,000 paper cuts with SaaS software, where each little application is a small monthly charge. For many SaaS options, it's a management nightmare to keep track of all the subscriptions. Are they being used? Do we have virtual shelfware? Did we cancel when people left or just stopped using the SaaS products? And now we have a new license to manage. And when we're looking at the cost, Salesforce made its fortune pushing SaaS software that had a low monthly entry price, but made big money by selling you add-ons. At one point long ago, we estimated that the per-user price that looked so attractive in the initial conversations about CRM would double or even close to triple by the time we got all the add-ons we actually needed to do the job. And there have been horror stories of SaaS implementations that ended up costing a lot more than anyone thought possible based on a simple low monthly charge. And of course, there are potential cost increases. Witness what happened recently with Canva, where some users reported price increases being as high as 300%. This was supposedly for the bargain replacement for a more expensive Adobe suite. And for those who think that all you have to do is not renew if prices are too high, you may realize that there's more to shifting software products than simply signing with a new partner. Data conversion, training, and changing your processes could be a huge barrier to change. Finally, while new pricing models are novel, there is a reason why so many people have been upset with cell phone companies. The different pricing models made comparison difficult and sometimes impossible. But companies are investing millions and even potentially billions in adding AI to their offerings. They want that back with a profit. So this is a classic case of caveat emptor, buyer beware. Do a careful business case, be prepared to build pricing models, and make absolutely certain that you know what the implications are of multiple scenarios. As the AI arms race heats up among tech giants, Salesforce's bold pricing move could be a game changer, or it could be an embarrassment as you go to explain to your CFO where those savings went to. And that's our show for today. You can find our show notes at our news site, technewsday.com or .ca, take your pick. I realized there was a bit of an editorial on the cost of SaaS. I would love to hear your opinions, agree or disagree. Send them to me at editorial@technewsday.ca. Thanks for listening. I'm your host, Jim Love. Have a terrific Tuesday.